Good morning, ladies and gentlemen. This is Clueless Trading Frank, and here's a quick pre-market update for February 17th, 2017. So I'm going to just kind of go through a bunch of stuff quickly and give you guys a little heads up on what I think is going on. So first of all, what you see in the background is a chart of the 12-month view. Approximately a 12-month view going into March of the E-minis, which is a proxy for obviously the S&P 500, and you can clearly see what's going on. Now, this is a chart that I've shown before, and I want you guys to keep this in the back of your head so you have a broader perspective on what's going on. Keep in mind that we're entering a phase here in the markets, and it's not like it's going to happen immediately, but remember, tops are rolling processes, and so are bottoms. So it doesn't happen in one single day. Markets come down, pull up, can't break the highs, and then they topple, then they retrace, all kinds of stuff. I don't know if this is a real tradable top in the market, in which case one can basically look for some sort of swing sizable drop or not. No one ever knows that because things happen so fast these days. You guys know that, okay? You blink an eye, markets are down 50 points, and within the next 15, 20, 30 minutes, the algos come in, buy it up off those tactical levels that I keep on showing every single day for people to trade off and effectively manage their trades. And then they turned around yesterday, case in point. And then the markets go positive, and the S&P goes positive. So even shorting is a very, very difficult game, and we've seen that happen repeatedly. So this is what you see. There's a channel here from getting the drawing tool here from last March. Let me see if I can get this. Okay, from last March. Okay, you can see that down here to 1 second. Anyway, it's in blue. So from last March to now. Okay, right there. So this is the wide channel that the market's been traveling in, right? You can clearly see how symmetrical this is because the markets, as I mentioned before, and I keep on saying it over and over again, are primarily run by automated programs known as algorithmic high frequency trading black boxes. Many different kinds, many different shapes, many different styles of algos, but that's really what goes on. Retail players involved, mom and pop is involved primarily through, in my opinion, through mutual funds, pension funds, 401ks that are run by different pension funds, which delegate the responsibilities to different hedge funds, you name it. Saying all that, you can see here that we are on the top of the channel. So getting really excited at this level doesn't really make any sense. Can we break out a little bit? Sure, we can. We can go higher. We can go to 2,400 plus or more. But the fact remains that we have to take into account what we see in front of us. So here we are at the top of the channel. You can see here there's a minor consolidation. There's the broad channel in the white lines. And then you have make this bigger, okay, and then you have the blue lines here, which are basically the smaller channel. There's a wide one. Here's a narrow one. Well, it's not really narrow, but that's what it looks like here. So the upper end that was touched was retested out here just on the 15th, 2 days ago, and this is where we are right now. Now, whether this is going to basically come into, and these are the scenarios, whether this is going to come into a big fall, and keep in mind, this is a rising wedge, and rising wedges do consolidate. There's no question about it. Rising wedges, as you can see here, back last March, April, do consolidate. So will this consolidate? Absolutely it will. I believe that's going to come in the month of March. Different factors I want to get into right now. I'll be covering that on the advanced group coaching sessions that I'll be conducting this weekend. And very importantly, people are really serious about understanding a lot of the dynamics and the correlations with what happens, not just with markets and stuff, how it affects your own profits, how it affects your own trades, how you can effectively manage your trades so you don't do stupid things. Well, that's really what all traders do. I do it too sometimes, okay? But the bottom line is I've learned from my mistake. I've effectively gone ahead and developed some fantastic good trading habits, and that's what I like to share with people. People really want to improve their trading health and be more consistent. Definitively sign up for the ACS. It's on the members area. Go ahead and do it. Sign up for the 5-pack session. Okay, very, very important. Saying all that, This consolidation is going to come in March. For now, is it possible that we come and test the, like we did here, test the rising wedge again? Absolutely, we can. Where is that? That's roughly about another 100 points below where we are right now. Um, um, Roughly 100 points below where we are right now, or maybe less. And it's right there. Try to change this color here so you guys can see. That's better. Exit. Okay. So good. So we come down here and then we try to make another attempt at a high. At that point, we are creating a newer high, which I believe can happen by the end of this month, if not by the first part of March. Okay. And remember, earnings are dying down, so there's going to be, the market's basically going to a little bit of a slumber period. So I believe that in March, for the first part of March, is going to be a very tricky situation, always specifically on the consolidation side, i.e., on the pullback side. Where can the pullback come to? The pullback, believe it or not, can come all the way down towards the 2240 level. So you're talking roughly about a 100-point drop on the S&P 500, 100 points, which translates into roughly 500 to 600 points. I'll call it 600 points on the wide side, taking a little margin of error. 600 points on the Dow Jones Industrial Average. 600 points on the Dow Jones Industrial Average, lo behold, brings us where? Brings us back, and this is how it all fits in. A 600-point down move brings us back to Dow Jones 20,000. Bingo. Because that 20,000 level will have to be tested to make sure that that's a viable level that the market can trade off. Doesn't mean 20,000 is always going to hold. It simply means that that is a level the markets want to test. Can it happen prior to that? Sure can. That's just markets. But this will happen, okay? And that would be somewhere in this range. At that point, the markets will try to have a sizable bounce. And that bounce again will take us up. If we fall 600 points, general rule of thumb is that we're going to basically have a retracement bounce, okay? Retracement bounce of roughly 200 to 300 points. Simple Fibonacci retracements. That's exactly the way it happens. This will happen fast. This will be furious. And the faster it happens, the better off it will be. So one has to keep that in the back of the mind when they're managing their books on their trading books and the positions they're taking. Doesn't mean swing positions that we have or other stuff is all going to be affected. Not everything gets affected. There could be days that we're down 300 points and there are biotechs that are up, or a single stock for some news reason is up big. That's just the nature of the beast. Okay? But I'm talking the general market momentum. So saying all that, you'll get a bounce of 200 to 300 points, which will basically take us from this 2240 level or so back towards that's 200 to 300 points on the Dow I'm talking about. So if we fall 100 points on the S&P 500, let's say 100 points here, we should get a 30. We should get a 30. If we get a 100-point drop here, we should get a 30 to 40-point drop, which would bring us back towards this level, and then we see what happens. So, so this, in my opinion, the 20,000 will be tested in the month of March, I think. And this is just a projection, and remember, forecasting is tough business. And then we try to bounce back, and then we see what happens. So saying all that, I just want to be clear about this, so you guys have a mental frame as to where you're going with that. Somebody gets really dogmatically bearish and bullish, well, bearish at this point, you know what happens. Try to short the market hard, market has resilience. This is a bull market, and there will be corrections, but this is a bull market. And some people will say it's a house of cards, it's going to fall. Trump doesn't know what he's doing. That's all garbage. Economic policies are get put in place. I believe the tax reform is going to be welcomed by the market. The big American companies are working directly and voicing their concerns, voicing their aspirations with the new administration, which I think is great. There's certain elements of the border tax and all that stuff that I mean, who am I? I'm just a puny little piker in the middle of this huge financial game, but I completely disagree with. But if they try to finesse it and make it a little bit smoother, give a bigger tax cut with this minor border tax, which basically means a VAT, value-added tax. If you guys been to Europe and Asia, you know what a VAT is. And the bottom line is, all that could be worked out. So this level here, the 20,000 level where the market broke out of, in my opinion, will get tested. It's a process, not just it just completely falls. If it completely falls apart in one day and we're on the short side, you're making millions. Exaggeration, but you're making a lot. But and if it's that fast, it's fast. Markets don't fall 600 points in a day. Let's just put it this way: 300 points, yeah, only in real crisis situations it's happened. It happens once a year, right? We drop about 600-700 points. But aside from that, some cataclysmic external event, you're not going to see that. So first move here, try to attempt to move here, then you get the consolidation. Okay, very similar to here. Pull back here, pull up here, and then you get the consolidation. Even in the middle of consolidation, they're up 50, up 100 days. But I'm just giving you an idea what happens. So that's it. That's on the actual market side. Now, let's take a look at the VIX. So here's a picture of the VIX from last March till now. Okay, VIX 27 climactic crisis, and then it starts to ease back. So when you're looking at the VIX chart from an educational standpoint, you got to look at the peaks and the troughs. The troughs, which are the bottoms, are generally rolling. You can see that they're kind of rolling, and then it just takes off. And that's pretty much what's going to happen here too. That was the reversal hammer. I'm going to zoom in and show you. And I showed that on my charts. Which reminds me, you gotta track my tactical charts. And not only that, you have to understand it. For that, you have to take that extra step of working with me, and I'll spend my valuable family time to try to help as much as possible. But anyway, so this is pretty much what's going to happen. The VIX is going to spike hard. The first level of contact on the VIX is roughly around the 15 level. We've seen that's acted at major resistance, and then of course you got these levels here. This is basically when the VIX pops to 20, that you're looking at markets down 400 points or so. Being a daily chart here, and this is generally the 23 to 27 level is at this point juncture in the market, the way things are, the way interest rates are set, and the correlation between all the different dynamic asset classes, gold, all that stuff. I don't expect the VIX to basically get towards 2730. Whichever the case, these are great buying opportunities because these are correlated with tactical market bottoms and multi-month rallies. Saying all that, keep an eye on the VIX because this level here towards 15 looks likely, and it's going to happen fast. VIX is showing up about 2.5%, 2.6% pre-market, which futures down about 8 points. And I'm just trying to see something here. Okay, and then bottom line is that the rolling bottoms, so you can see that, and then the spikes. So you need to basically position yourselves through whatever instrument you want, whether it be the UVXY, VIX calls, whatever the case may be, TVIX, short ETFs on the market. On a hedge basis, once you start to see the VIX break certain levels, breaking 13 means that it's going to go to 15. Breaking 15, and it doesn't happen in a straight line, right? Unless you get one of these big events. So you'll and that big event, by the way, started off from a level that didn't look like the VIX was going to turn up. So VIX is a derivative. It's a derivative, right? Fear index. So the bottom line is that it moves very different than individual stocks. Individual stocks don't show these type of patterns. Not much to say there. So that's it. In the meantime, let me get this side. So keep this in mind. You when the VIX gets down towards 11, you might want to buy some VIX calls or those instruments that that you have, or I talked about right now. And you can just have that hedge on the side. You don't need to trade the VIX on a day trading basis. So just passing on some things I've learned. Now let's take a look at a couple of. Actually, let me just go back here. Let me go back to what's going on right now. I'll show you the bigger picture, what might happen. So let's see this is the 1 hour chart. Okay, and the 1 hour chart which I repeatedly showed yesterday, through different, it was drawn in a different structure, removing all the drawings here, okay, is not showing any major cataclysmic situation. So bottom line is, if you draw the lines, here's your breakout line, and all this has been posted yesterday. Here's your trading band, 2262, 2300. Here's your acceleration phase. And again, I repeat, you have to go through every single one of my charts. You don't need to sit there for hours staring at it. I expect if somebody does that, they're either very passionate about technical analysis or they have nothing better in their lives to do. Aside from that, just glance at them. Try to understand. The more you understand them, the faster they talk to you. You know, it's really as simple as that. But you have to basically scan it if you're trading during the day, or scan it after hours when you're home. So this is still a consolidation channel. And that consolidation channel, basically on the E-mini level, is around the 2330, which I mentioned. You can draw from the breakout level. You can zoom in, right? You do some lines that you can draw on this. I would call this one of them, and that's around the 2330 level. I think we're getting there. And once we get there, that's where the fight begins. Then the next level of interest comes in here. Remember, these were big reversal candles. This was the breakout. Big reversal candles, and the sudden move up, the big 3-4 candle move that takes shorts by surprise. But looking at this here, you don't know whether this is going to all of a sudden turn green and move higher. There's obviously selling going on pre-market, and but this is where your fight zone comes in, and one can short. Sure, they can. You can have a hedge, but then what if it does that? That's why you always, whether you play the long side or the short side, unless it's a swing trade, okay, unless it's a swing type of trade, you want to keep your sizes small, because otherwise you're going to get blasted out. Trading the SPX, trading the RUT is like trading futures. They move at light speed unless you're structurally attuned with the charts that I'm putting across, the patterns. Don't trade them, because you won't be able to know what to do. Here's your consolidation. Here's your level where if on the puts you'd want to be covering. If it breaks below that, then obviously we're going to go to, but not obviously, but high probability that it's going to go towards 2320. And these are all defined. It could come down here, make a sharp bounce. Everyone gets excited around here when they should be excited buying it here, and you see it all the time. And then from here, it could be a rejection. It could be back to the channel again. If this is a downtrending channel, these dotted red lines, then you're going to basically keep on making lower lows, lower highs and lower lows. That's downtrending. Now, at what point, obviously 2280 is the level, if you want to look at it that way, where actually the range breakout was at 2300. So 2300 at one point or another will get tested. Then you're talking about 47 points on the S&P 500 or 50. So you're talking about 300 points if we on the Dow, bringing us down to 20,300 if we come down here. At that point, you should expect to see a sizable bounce, and it'll be fast. That reminds me of another thing. If you're trading actively, or you're trying to trade these S&Ps and stuff like that, that I put across, you have to be fast, and you have to understand these patterns and tactical charts that I'm putting across. Because you can't be sitting around thinking, oh, it's going to go higher, it's going to go higher. Look, right now as we speak, there's a sorry. Right now, this could turn green and then head towards the upper end of the channel. And all this makes money. This is not like some lecture I'm giving you in a boring technical analysis class. Because if you're in a bunch of SPX calls at, let's say, $2-3, the weekly ones, and you're not watching your charts and they drop to 60 cents, and then you panic, you sell everything at 60 cents, which I know a lot of you do, instead of coming in and lowering a cost, and then you see it just rip